So walk me through a pro forma. So a very common place to find a pro forma is in the offering memorandum. The pro forma basically outlines the property's financial projections and is a critical part of the sales process for both the buyers and the sellers. Of course, the buyers and the sellers will probably have different assumptions. The buyers will typically tend to have more conservative assumptions, while the sellers will typically have more aggressive assumptions. However, all in all, the pro forma is important because it basically provides a benchmark for the property's future cash flow outlooks. Including in the pro forma is the potential revenue, which is the revenue that would be generated by the property if it was running at full capacity and occupancy. However, this is not always the case because that's kind of impossible. So there are revenue adjustments that are deducted from the potential revenue. And these could be absorption and turnover vacancies, rent abatement, which is free rent given to the tenants to try to induce them to lease out the spaces. And then there's also credit losses, which are, sometimes tenants defaults on their rent obligations. From there, we get the effective revenue. And then after the effective revenue, we basically subtract the operating expenses, which are basically the month-to-month cost of operating a certain property. And these will include insurance, repairs, security, taxes, management costs, and these costs are deducted from the effective revenue. From there, we get the net operating income, which is one of the most important line items because this is the ones that investors really look at because it basically entails the property's ability to generate recurring income. And then from there, we deduct the capital expenses, which is infrastructural costs or costs needed to maintain the value of the property. For example, if the building needs a new elevator, these are costs that are associated with that. And these also include leasing costs such as tenant improvements or specific leasing commission costs. From there, after we subtract the operating expenses from the net operating income, we get our operating cash flow or our free cash flow. And this basically represents the pure cash value available to the investors after expenses are deducted. The last thing is the reversion cash flow, which represents the proceeds available to the investors after the property is sold. This is usually calculated by taking the NOI for the year after the hold period and dividing it by the estimated reversion rate or the exit rate, cap rate.